Well, it's the most important thing going on in markets, in my opinion, because if it is indeed signaling that we're entering a bull market, usually bull markets in gold are secular at their nature. And so we're likely to be entering one here. And if that's the case, there's a lot of things that are very mispriced. And there's a lot of opportunities on the upside of things that need to be re-rated much higher in valuations. And you can say that that's the miners, you can say that that's silver, that's platinum, that's other precious metals, that's copper. I've never seen a gold market that actually it starts a secular move that doesn't also trigger other commodities to do the same. And so there's a lot of very positive things happening across the space. And I can't recall a better time to be a precious metals and commodity investor than today.
For the first time since 2011, gold reached new all-time highs during Easter, marking a significant milestone. This year coincides with the end of gold's bull market during the global financial crisis, when it peaked at $1,895 in September. Tavi Costa is a prominent figure in the financial world and a key strategist at Crescat Capita. In the unfolding narrative of market dynamics, Tavi Costa predicts that the recent surge in gold prices marks the start of a bull market, potentially leading to a broader revaluation across precious metals and commodities. On Tuesday, gold reached yet another record high as traders rushed to acquire the safe haven asset amidst escalating tensions in the Middle East. Despite a stronger dollar and reduced expectations for U.S. interest rate cuts, investors showed significant interest in gold. Highlighting the contrast in gold accumulation patterns between Eastern and Western investors, Tavi points out that the recent price surge is driven by central bank purchases rather than inflows into ETFs. He also expects mining stocks to follow suit as market fundamentals strengthen. Available data for February shows that reported global central bank gold reserves rose by 19 tons, the ninth consecutive month of growth. However, a combination of slower gross purchases and a higher sales volume meant that February's buying was 58% lower than January's total of 45 tons. Meanwhile, Tavi underscores the imperative for central banks to enhance the quality of international reserves, citing a decrease in foreign treasury acquisitions. According to data released by the U.S. Department of the Treasury, China's ownership of U.S. Treasury debt decreased to $797.7 billion in January, marking the conclusion of 2 months of growth. Central banks are eyeing gold as an alternative to U.S. Treasury debt amid inflation, geopolitical risks, and a push for diversification in the global reserve currency system. Additionally, analysts draw attention to the proportion of gold in these reserves, which still needs to catch up to historical norms, despite reaching 19%. Now, we present the clips of Tavi Costa's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Well, it's the most important thing going on in markets, in my opinion, because if it is indeed signaling that we're entering a bull market, usually bull markets in gold are secular at their nature. And so we're likely to be entering one here. And if that's the case, there's a lot of things that are very mispriced. And there's a lot of opportunities on the upside of things that need to be re-rated much higher in valuations. And you can say that that's the miners, you can say that that's silver, that's platinum, that's other precious metals, that's copper. I've never seen a gold market that actually it starts a secular move that doesn't also trigger other commodities to do the same. And so there would be a lot of things that would be linked to that move itself. And it's important to note that we are yet to see Western societies, especially general investors from Western societies, to start really purchasing the metal and accumulating to the same degree that we're seeing with other Eastern societies, especially central banks in other Eastern parts of the world. And therefore, why we're seeing this breakout in gold that is not really intended with a large increase of flows into the GLD. And also, you can tell that this is most likely driven by purchases of central banks because the miners are not moving yet. And miners are not purchased by central banks usually, and therefore they are not receiving this optimistic side of the flows. But they will likely receive that from the general market as we see not only the improvement of the economics of their own projects, which we're seeing. I usually talk about the second wave of inflation and the likelihood of the reacceleration of consumer prices. But notice that the miners themselves are also starting to see a very good increase of their own free cash flow growth. And so if that's the case, the price of those shares are yet to also follow the upside of the metal as well. So there's a lot of very positive things happening across the space, and I can't recall a better time to be a precious metals and commodity investor than today. Well, the main reason for the continuation of that trend that is likely ahead is because central banks are being forced to improve the quality of their international reserves. And as you look at the amount of issuances relative to how much purchases of treasuries, because central banks are not selling treasuries yet. That's an important point that a lot of people miss. Foreign treasuries are declining, not on the back of central banks actually selling them yet. They're just not being buyers relative to how much it's being issued. Imagine if we do see central banks selling that. Wow, that could be another pressure on the downside for treasury returns. And so that's such an important point to point out. The other thing to point out as well has to do with how much gold central banks own relative to their own international reserves, which is now approaching 20%, but still 19%. And we're yet to see that actually move towards historical average, which used to be 40, 50%. And why are we going to see that is a big question. Well, because especially when interest rates start to rise, inflation starts to rise, all those things are linked. What causes is disruptions in the monetary system. And so you start to see big FX volatility, which creates the need for a lot of central banks to actually improve the quality of their reserves. And I think we're in the process of seeing central banks being forced to improve their international reserve quality. And so that is really the big driver of all this. And wait until the 60-40 portfolios go away and start actually being called something else, because they have to actually move away from owning 40% of treasuries and maybe actually, or bond market or fixed income instruments, and actually start stepping into the gold space or the hard asset space. And so there's a lot of opportunities there. And that's why I like this market, is because when I think about a thesis, I think about the optionality of that to work. And I see a lot of optionality, a lot of different ways that these things could start happening and unfolding the way I think it will. And so that's why the excitement and conviction comes in.
According to Tavi Costa, silver is expected to follow suit and experience upside potential as the gold bull trend continues. Despite potential short-term skepticism, he views silver as undervalued and views mining companies as asymmetric opportunities. In early April 2024, silver continues to lag behind gold's performance. Still, it may only be a matter of time until gold's sibling catches up with the yellow metal, presenting a potential opportunity for increased value. Shares of silver miners rise, tracking the metal prices, which hit its highest level in over 2 years. Spot silver is up 3.4% at $27.02 an ounce, after Federal Reserve Chair Jerome Powell reiterated that recent readings on job gains and higher-than-expected inflation do not materially change the overall picture of economic policy this year. At the forefront of his strategic vision, Tavi's unwavering focus remains fixed on these sectors, where he envisions substantial potential for market success. Let's get back to the interview.
I think there's always the potential for something like a few or maybe 6 months of underperformance. But ultimately, the markets are efficient enough when you see gold prices really surging to, 25, 26, 2,700. Obviously that changes the dynamic of owning a mining company and changes the dynamic of even silver itself, because they're all linked historically. And as we've seen, usually beginning of gold markets they don't usually occur with the gold to silver ratio at historical low levels. They usually happen when you are at historical high levels. And so we're yet to see silver really lead the way to the upside. But there's always going to be those short timers, investors or so, that will be caught up in this narrative that this time is different. And because of markets being irrational for a couple months or maybe even 6 months perhaps, it may cause people to be spooked out of that trade. But it is, in my view, the cheapest metal on earth, silver itself, but also the miners will, in my view, look as asymmetric as they could be. And so that will be a very important trade for the next 5 to 10 years, as we see this confirmation that the gold trend is actually a long-term one. And I wouldn't be waiting for this. I mean, this is the main reason why we've been building a portfolio on this for the last years. And you never know when things are going to turn. You can try to be as smart as you can, but nobody knows when things are going to turn. But when you have the underlying factors there, which we do today, and you have gold moving the way it's moving, it's time to focus on what's next. And not only gold is likely just at the beginning of that trend, but other things are starting to show signs that they're also about to move. And as we all know, gold and silver miners and silver and gold miners and so forth, they usually well known for having very explosive moves. And look, I go around the world to meet with investors and go to conferences and all sorts of things that are related to our industry. And I got to tell you, there's nothing more hated than gold miners. Not uranium miners, not silver miners. There's not copper miners. It's even worse than coal, the coal industry. And so to me, or the cannabis industry even. And so to me, most times the skepticism morphs into opportunity. And this is going to be the case, in my opinion, here again. So that's why I'm laser focused on this, because I think this is going to be the big winner.
In early April 2024, gold made even higher highs, and the market consensus favored Fed interest rate cuts before the end of 2024. Moreover, a highly contentious November election is on the horizon, which could translate into market volatility across all asset classes. Given the recent trends in the precious metals market, what factors do you believe will significantly impact their performance in the coming months? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.